Our last homework problem, 1226, which they're calling the comprehensive problem, but it's not anything like the comprehensive problem you did for chapter 11. So this is going to be a little bit easier. But what we're looking at here is we're just looking at an investment decision where we have three options. The first option is a corporate bond, which is debt. So you're actually going to lend money to a corporation by buying their bonds. The second option is a preferred stock, and the third option is common stock. Now, the important thing to see here is that these are three different companies, which that are maybe more or less successful. So there's a lot more you'd want to look at besides just what we see here in terms of how are these companies actually performing. What do they do? There might be some moral or some ethical issues. When you think about the book that we're reading, Triple Bottom Line, maybe a supernova isn't doing near as well at embracing sustainability as the Dwarf Ores company is. So that might be part of your decision. So there's a lot. I just wanted to point out there's a lot more to this decision than just the rate of return that we're going to calculate here. But having said all that, let's go ahead and calculate the rate of return for each one of these options. So part A, we just simply say the face value of the bond is 1,000. Put that in there. The coupon rate is 13%, so put that there. And then the years to maturity, but there's only 16 years of life left, so we want to put that right there. And not a 20, because there's only 16 left, so we're only going to put 16 right here. And then the bond is selling for $1,147.58. So we'll put that 1147.58. And we can see that for some reason, why? Oh, I see. Wow. There we go. Okay. So the average annual rate of return for this bond is 11%. Okay, so let's move on to the preferred stock, which is a par value of $100 per share. So put that right there. And the dividend per period is wait a minute. Par value is $100 per share. Let me make sure I did this right. I don't want to confuse anybody. Okay, so we put 40. All right, 140. So why they see this is what they do sometimes. They give you stuff you don't need. You don't need that, so that's just sort of will throw you off. The current price is 140, right? And let's see, the annual dividend is 14. So put that right there, and we can see that the yield per period of this preferred stock is 10%. Now, common stock, we have a market price per share of 300. Put that right there. It costs more per share. And an expected dividend of 39. So we'll put that right there. And then the growth rate is going to be 3%. Okay, so put that right there. Whoa, 3%. Okay. There we go. Well, for some reason it's going to be stubborn. There we go. Okay, 16%. So, once again, if we only looked at the return, you jump all over the common stock right here, right? But you have to also keep in mind that the dividend right here is what was paid yesterday. So we don't have any guarantees at all that this dividend is going to continue to be paid. And the growth rate right here is just, just a calculation based on assumptions of how the company's going to do. So this isn't, and in terms of common stock, the company, as we learned way back in chapter 4 or 5, is not obligated to pay a dividend at all. In a preferred stock, they are. In a preferred stock, you're guaranteed the dividend. So you could argue that even though the preferred stock is a lower return, it's much less risky. The bond is probably less risky, but the bond is going to cost you more, right? You've got to here you could buy less shares or as many shares as you wanted. You don't have to make this a larger over $1,000 investment. So there's a lot of different variables you would look at in making this decision. So the answer to your question would be something along the lines of, you really can't say for sure unless you do a lot more in terms of a risk analysis and learn about these companies. And I would add to that and say, once again, I would say you'd want to, if this is going to be something you're going to be in for the long term, you want to make an analysis on which of these companies is doing the best job at embracing sustainability, which is what we've been talking about the whole semester with the reading the book Triple Bottom Line. Okay, so that's a question or problem 1226, and that's it.